Hey guys, I'm Roger Herring. I'm the Investor's Accountant, and thank you for coming by our YouTube channel. Before you leave today, be sure you hit subscribe and click the bell. That way you won't miss any of our free educational videos. So right now, click subscribe, hit the bell, and a great video is coming your way right now. Hey everyone, I'm Roger Herring. I am the Investor's Accountant, and hey, welcome to the next segment of our C-Corp education. Today we're talking about the reason that we use a C-Corp to begin with. It's called the tax rate split. Now what in the world is that? That's where we take control of where our income is taxed. We have a C corporation that we can have a 21% tax rate under the current law, or we can have the income taxed on our personal return at whatever our income rate is. And the whole idea with tax rate splitting is to control the amount of money that comes out of the C corporation onto our personal return. Now, before I get into it, let me explain something. This only works if you don't need to take the money out of the C corporation. Okay? Here's how a typical split would work, but let's get some baselines. And we are going to use the 2021 tax rates. Yes, I know the proposal is for the C Corp to go to 28%, but hey, that's still less than 39.6%, which is the proposed maximum personal rate. So here we go. All right, let's just assume that we have $800,000 of taxable income. Okay? If this money comes to us through an S-Corp or a partnership, which is a pure flow-through entity, it comes straight to our income tax return, it's going to get taxed at 37%, the top tax rate. Now, what is the tax on that? The tax is $232,000 and some change. Okay? This is what happens if you make $800K under the current law and everything comes through to your personal return. So, let's involve a tax rate split. So, we have a C Corp and we have our personal return. And let's just say, for argument's sake, we need to live on $400,000 a year. And we are able to keep $400,000 a year in the C corporation. Here's what's going to happen. This $400,000 is now in the 32% tax bracket, and the income tax on that is $73,000. This $400,000 in the C Corp is taxed at 21%, and the tax is $84,000. Now wait a minute, Raj. How is it the 21% here and we got $84,000 and 32% here and we got $73,000? Let me explain the concept in taxation. It's called the progressive tax. In our system, as an individual, amounts of income are taxed at different rates. The first $10,000 is not $12,000 is not taxed at all. Then the next, say $30,000, $40,000, $50,000 is taxed at 20%. Then the next at 25, the next at 32, and it keeps growing. Whereas all 400,000 is taxed at a flat 21%. But now watch this. If we add the 73 and the 84, our total tax is $157,000. Now, 232 less 157, that, my friends, I'll put it over here on the corner, saves $75,000 using the tax rate split. That's why we do this. Now, I'm going to remind you again, you have to leave the money in. But Roger, we do need to take this $400,000 out of the C Corp. How do we do it? Well, there's a few ways that we can do it. We can do dividends, and everybody screams double taxation, but these are qualified dividends and taxes capital gains. If we do it as salary for the first $140-something thousand, we're going to have to pay Social Security and we have to pay Medicare on the whole thing. So once again, it comes down to a numbers game. But there's another way we could do it. Remember last week we talked about upstreaming? Well, guess what? If you can upstream, you can also downstream. So how do we downstream? What we do is we have a C-Corp. And that C-Corp is bringing in $800,000. Now, I'm going to use a similar example to last week. Let's say I set up a partnership or an S-Corp. And this is where I put my acquisition team. And now I can pull $400,000 by billing the C Corporation down to the S-Corp or the partnership, which is the pass-through. So now, after paying out the $400,000, I have $400K in my C-Corp, and I have $400K in either this S-Corp or partnership that's going to flow back to my personal return. Now, why would I use a partnership? I use this a lot with married couples, a spousal partnership where one spouse is passive and they're not subject to self-employment tax. It's another tax avoidance technique. But we'll talk more about that later, or there's actually a video on the spousal partnership. Check it out. Until the next time, guys, I really hope you have enjoyed today. I'm going to say now, Roger out.